Hello. Hi friends, welcome to the crash course session. This is our session for unit number 24. The topic name, as you can see, is derivative product, and we will cover every important thing from where questions are repeatedly asked from this unit 24. So welcome to a simplified yet powerful breakdown of options. So here we are talking about options, a financial instrument that is all about strategy, timing and precision. So what exactly is option? An option give you a right but not the obligation. This is very important thing I'm telling you, right? Because if you understand this, the main concept is clear. It gives you the right but not the obligation, right? It does not give you the obligation, right, to buy or sell an asset at a fixed price in the future. So you can see written, it is a right but not an obligation to buy or sell an asset at a fixed point in the future. There are two types of options are there. One is called call option, which means the right to buy. Another is called put option, the right to sell. And these right apply to a future date. They both call option and put option apply to the future date, making option a powerful tool for both speculation. So whether you speculate or whether you hedge, for both of them this option is a great tool. If you look at the types of option that we have, so let me show you the types of option. Just wait a minute. Yeah, so you can see the European American option is there, and there is something called European option. You know what it American or European option? Let me tell you. So American option means it can be exercised anytime. American, A for America, A for any time. This way you can remember it. American option can be exercised any time before expiry, whereas European option, it can be exercised only on expiry date. It can be exercised only on expiry date. This thing you must note it down. And fun fact is that in India, mostly option follow the European style. Post 2008 crisis, American style option are banned in many market. There are some key terms which you need to remember. The first is called strike price. So here let me show you the detail regarding the strike price. So one thing is that this is a crash course. It provides you complete important information in just 20 to 30 minutes, so that your main focus should be on MCQs attempting. So what is a strike price? A strike price is the price at which the option holder can buy or sell, which means it is fixed by the holder fix it. And expiry date is the deadline to exercise the option. These two parameters are fixed by the holder at the time of purchase, that yes, I will exercise this particular option on this particular date. The price at which the option holder can buy or sell is called strike price. And expiry date is the deadline to exercise the option. And so European American option we have already told you. Now when there is something called moneyness. Moneyness, is your option profitable? So whenever I say this moneyness, it basically means I'm answering a question, that is option profitable? Is it really profitable? That is what I am answering. So moneyness tells you where the strike price stands compared to the market price. So see, I just told you regarding the strike price, regarding the market price. So where the strike price stood in comparison to the market price, that is what is told by moneyness. So there is something called ATM. ATM means add the money. So add the money means what? That strike and spot price both are equal, or forward price both are equal. Then there is something called ITM, which means in the money. So in the money, two things are there. Try to understand. If it is call option, then a strike will be less than the forward price, and if it is put option, then a strike will be greater than the forward price. And the last is called OTM, out of money. Then in this case, if it is call option, then a strike will be greater than forward, and put option, a strike will be less than the forward. I have told a trick to remember this thing in our videos, right? Now if you look at the intrinsic value, in short it is noted by IV. In short, intrinsic value noted by IV. So this is the real value of the option. Remember, intrinsic value is called the real value of the option, right? So what happened? Only ITM option have intrinsic value. Remember it, very very important, that only ITM option have intrinsic value. For call option, intrinsic value, if you want to find, how to find the intrinsic value? You subtract a spot and a strike. And for put option, you subtract a strike minus a spot, right? So this is how you will find intrinsic value for call option and put option. And so this is only ITM has intrinsic, I told you right? While ATM and OTM, intrinsic value is 0. There is no intrinsic value for ATM and OTM. Understood? Right. So friends, one more thing is there, is called time value. After intrinsic value, something important is called time value. So it is the extra premium you pay for the time left until expiry. So one formula you must remember, that if you want to find the option price, so you add two things. First of all, you add the intrinsic value, and then you add the time value. And this time value is highest at the ATM, at the money, right? Time value decreases as expiry near, or when the option is deeply ITM and OTM. So let's summarize what we learned from this particular slide, is that options are more than just a bet. They are a calculated strategy. So once you understand the types, terms, valuation, you can unlock a world of smart financial decision. And that is all we have discussed just now. We have covered every possible aspect in just one single picture, and this will help you, really help you, right, at the time of examination or revision part. And that is the beauty of our crash course. It helps you revise the entire content in a super efficient way. In just 20 to 30 minutes, you can revise the entire chapter. Right now, friends, let's switch our attention to the world of stock option. So in the world of financial instruments, stock and index option offer a powerful tool for both hedging as well as speculation. Let's explore the type and feature and make them so versatile. So first of all, what is the stock option? Let me take you to the world of the stock option. See, a stock option gives you the right to buy or sell a company equity as a predefined strike price. Yes, there's a fixed strike price and you can buy or sell a company equity. That is the stock option give you. For example, suppose you hold a put option of 1,000 share of Maruti, right, at 29,000 at rupees 9,000. So suppose you hold a put option on 1,000 share, right, of Maruti at 29,000, expiring on 30 June 2022, right. So suppose the price fall below 9,000. So you exercise the option and sell at 9,000. And if your price is exceed 9,000, you simply sell in the open market, right? No option exercise. Simple. It is quite simple because put means what? Selling. Just you have put option. That means it gives you the right to buy or sell a company equity. So in this case, you have put option. That means you can sell it at 9,000. Suppose the price is below 9,000, then you will exercise this particular option. And if the price is larger than 9,000, you will not exercise. You will simply sell in the market. So that is what stock option is all about. I told you about the stock option now. So it's a smart move to lock in or here against loss. Then the second part is called index option. What is the meaning of this index option? Let's see in this particular slide. Right, I told you now, every aspect will be made clear. From all the things have been taken from your Macmillan book. Index option means what? These are the options based on the market indices. And market indices like Sensex and Nifty, not individual stock. So a put option help you protect against market fall. In the case of index option, it help you protect. Put option help you protect from market fall, and call option protect against index rise. Call option protect against index rise. It is useful for a stockbroker, a stock buyer, right? Those who need the downside protection. Now, if we talk about the type of stock option, in the right side, I will tell you, right, the type of stock option that we have. So one thing that is called plain vanilla option. You know about this plain vanilla option? What is it? This plain vanilla option is a type of a stock option. What it is all about, let me explain using an example. So basically, these are the simplest and cleanest type of option. There is no complex condition, right? It's perfect for him. And premium you must plain vanilla option, right? But comes with a trade-off. What is trade-off? The trade-off is that you have to sacrifice either upside or excess, right? So think of it like a standard coffee of the option world: simple, reliable, and effective. It is simple option, no condition. It's ideal for him, right? It is a combination of options, and premium is lower. That means you either sacrifice upside or accept some risk, right? So design as per holder risk appetite. And there's something called zero cost option. You know about the zero cost option? Let me tell you. So you can see zero cost option. Plain vanilla option, just now I told you, zero cost option. This involves no upfront premium. No premium you have to pay, but have built market risk. In the case of premium, since you are exercising this option, you have to pay premium. But in zero cost option, why zero cost is no premium you pay. That is why it's called zero cost. But it has some market risk there. Like suppose there is something called range forward. Range forward means what? You get better rate unless market crosses a level. And there's second is called which means it becomes inactive if market moves in a certain direction. So it is ideal for those who want protection without paying premium. Suppose you want protection, you want insurance, but you don't want to pay premium. Then the zero cost option is a very ideal thing. But okay with yes, you are okay with certain condition, but you don't want to pay premium, right? It's okay for them. Like if range forward, high rate if market crosses a certain level, and value option, that is it becoming high if market move in a certain direction. That there is condition involved here. Because not paying premium, they have to satisfy certain condition. And the third option is called exotic option. You know what is exotic option? See, these are designer option tailored to the complex strategy. So they combine option and they combine derivative. The combo of option and derivative, right? And they create a custom financial product. There's something multi-market exposure. There is something multi-risk hedging. There is something called high risk. It's not there for basic hedging. So friends, it is used in structured product. It is used for a structured product. They offer custom protection, not standard safety. That is called exotic option. So final thought is that stock index option come in many flavor, from plain to exotic, from zero cost to tailor made. So whether you are managing risk or maximizing return, there is a strategy for every kind of investor that you have. So can you tell me what is the flavor of choice? I've given you 3 flavor: exotic, plain vanilla, and zero cost. And those are asked every year from these 3 types. You must know everything about it. Now friends, let's move to the world of interest rate swap. Ever heard of swapping interest rate without exchanging actual money? That is exactly what is interest rate swap. It is a smart way to manage borrowing cost. So first of all, look at the definition. Right on the left side, you will see the definition of interest rate swap. In short we call it IRS. So IRS is the exchange of interest payment. Simply, it is exchange of interest payment on notional amount. Here you can see this. It is the exchange of interest payment on notional amount. Right? And notional principal is not exchange. It is just a reference. I told you that notional principal reference is not exchange. Rather, it is just reference. So the swap helps shift between fixed and floating interest rate and vice versa. So it is used for shifting either fixed floating to floating. Right? So that is what swap happens. Again, I'm telling you, principal is not exchange. It is just acting like a reference. Swap help you shift between fixed and floating interest rate and vice versa. Now the question is, how does it work? Let's look at the so friends, each part act as if they borrowed the full amount. Each part act. So there are 2 parts. There are 2 parts. So each part act as if they are borrowed the full amount. But in reality, they only settle the net difference on the aggregate date. Think of it like splitting the bill. Only the difference is paid. That's it. Nothing else. But it looks like they borrowed the full amount. Let's understand it with an illustration to make it more clear. So here I have provided illustration on the right side. You can see, say a company, suppose a company, right, it is with a demand at 7%, right, fixed, but want to benefit from a floating rate. So what they do, they just swap, right, they agree to pay floating, which is 2% rate, right, in return, they is 7% by bank, right. Suppose bank pays 7% to the company, so the company pays treasury bill plus 2% to the bank, right, and suppose you, what happened, company pays 6% and receives 7%, so the result is saving of 1%, isn't it? So basically, this is the advantage of having a swapping with the bank. It is smart, right? Now let's look at the benchmark rate. What is the benchmark rate used in the case of IRS? Every aspect has been taken care of in this particular slide. You did not remember anything. If you revise it twice, this will be more detailed. Right? Instead of learning from 10 different material, just revise one material 10 times. This is the secret to success in the CAIIB. And that is what we do in our crash course. That I provide pinpoint content. If you go through only that content 2 to 3 times, those theory and solve sufficient MCQs based on them, that is your pass to the CAIIB. Nothing can stop you from receiving good marks in the examination. So now friends, let's talk about benchmark rate. A floating link is often linked to a benchmark like treasury bill, right? A risk-free rate. So the total floating rate can be it includes plus credit premium. Obviously, credit premium you have to pay some premium for exercising this interest rate swap. Now, if you talk about swap and conversion, so see, there is something called swap buyer, they fixed, and there is something called swap seller. So who receive fixed, right? So company may pay fixed and receive floating, or vice versa, depending on their risk profile and their rate outlook. So what we just learned is that interest rate swap, it means only interest flow exchange. This one is not exchange. It helps manage exposure to changing rate. It is great for cost saving and flexibility and financial engineering, right? Now, friends, let's look at the financial benchmark and interest rate swap. Very, very important. In the world of finance, benchmark are the heartbeat of the interest rate swap. They help determine how much interest is paid or received and by whom. Let's break this down beautifully. So first of all, we have the INR benchmark. So these are commonly used interest rate reference in rupee swap. If we undergo rupee swap, the commonly used benchmark are the following. The first is overnight MIBOR. This is called overnight Mumbai Interbank Offered Rate, 90-day Treasury Bill, which is a short-term government security rate, CP rate index, which is commercial paper, IM, BMX, CMS, and MIFOR. So these are used for medium to long-term swap. So these benchmark guide the floating leg in an interest rate swap. If you look at the type of interest rate swap, already I told you there is something called plain vanilla swap. The most common things, fixed to floating, it is allowed in India. If you talk about the second type, it is called Quanto swap. You know what is Quanto swap? Quanto swap means payment in home currency but based on foreign interest rate. Payment is done in the home currency like INR, but it is based on the foreign currency rate. Coupon swap. Coupon swap means what? Interest fixed in one currency, floating in other, great for international deal. So in one currency interest is fixed and in the other currency it is floating. Interest rate is floating. Then it is good for international swap. And there's something called swaption. Swaption means what? You read it right. These are options built into swap contract. So see, it is combination of two things: option plus swap. Option built on swap contract. You can choose whether or not to enter into a swap later. If you look at the USD benchmark here, can say USD benchmark. Friends, for global swap in the international market, swap often refers to ARR, alternate reference rate. Means it has replaced the LIBOR globally. Now earlier it was just LIBOR. Now it has been replaced by ARR. This is the USD benchmark. For global swap in the international market, swap often refers to ARR. And the second rate is called Fed rate, which means the key. And let me zoom a little bit so that it becomes very much clear to you. So what we learned from this discussion is that benchmark is the base for calculating floating interest rate. Swap can be domestic or swap can be cross currency. Each type of swap fit a specific business need or market condition, and regulatory body ensure the game is fair. Now friends, let's look at FRA. Have you ever worried about interest rate rising before your loan start? Tell me. Suppose you have taken a loan. Before a loan start, you are worried about interest rate rising. Have you ever done that? So forward rate agreement, are you sealed against this risk? Yes. So forward rate agreement or FRA, what it does, it let you fix an interest rate today, right? It let you fix interest rate today, right? You can think of this like IRS. It's just like an interest rate swap, right? But with a twist. What is the twist? The twist is that it is just one single payment, not a series, right? So if you are worried about interest rate will rise in the future, I have just taken a loan, then you can go into FRA, right? It's just like an IRS but for a single payment, right? Not a series. So it is mostly used to hedge interest rate on future deals, right? So if you talk about the key difference between FRA and IRS, it is quite simple, that IRS is an ongoing, IRS is an ongoing periodic interest flow, but the case of FRA, it is just one time interest payment in the future. It is simple, direct and to the point. Let me give you one example of this to understand. So suppose a company loan reset on 29th June. Suppose a company loan reset on 29th June, right? Now, basically they fear interest rate may rise by then. They fear that loan will reset on 29th June and then interest rate may rise by then. The solution is that they buy 6/12 FRA, right? So which means locking in today's rate for the 6-month period from 29th June to December. Right, so what is the difference here? 6 months is the difference. So they have locked in today's rate. What is the today's rate? They have locked in the today's rate, right? Starting from 29 June to the December. So since now they have fixed rate, this is a kind of peace of mind, right? This is a kind of peace of mind. So they lock the today's rate, starting from 29 June to still 6 months till December, right? So if we talk about the market conversion, see how it is done. So rate fixed in advance, it is based on end of the previous period, right? Rate is fixed in the advance and interest paid at the end of FRA period. Remember, whatever interest is payment is done, it is paid at the end of the FRA period, right? And but interestingly, payment is settled at the start of FRA period and discounted back to present. This is how the market convention works. Rate is already fixed in advance, right? And then interest paid at the end of FRA, interest payment will be done at the end of FRA, but payment is settled at the start of FRA period. Right. Now, if you talk about the valuation, so FRA are typically valued using some risk-free yield. Their valuation is done through some risk-free yield curve, like government security in India, and if the market is liquid, then interpolated from market rate. Or trader may use the swap curve directly. So what we learned from this discussion regarding the FRA, that FRA is the interest rate insurance for future period. It is simple, one-time cash flow tool. It is used by smart corporate to protect budget from rate hike. Now let's end our discussion. So remember, FRA is the calm in the storm. It locks in certainty for what is coming next. Now friends, derivative might sound complex, but in India they have been crafted with clarity and control, right? Thanks to ISDA, right? So RBI guideline, keeping it clean and clear. Let's look at it. What does RBI guidelines shows? So basically in India only plain vanilla IRS are allowed. I told you earlier, right? So in India RBI allow only plain vanilla IRS. Here you can see, right? For hedging and speculation, no exotic, no complicated structure. Corporate can use IRS only for hedging, not speculation. Remember it. So RBI allow corporate to use IRS just for hedging, not speculation. Let me show you where it is written. Yes, here you can see You can see it. Only plain vanilla IRS is allowed, no exotic structure. Corporate can use IRS only for hedging. Remember this key point. This will help you in the examination. And you know, bank, PD, FI, mutual fund, right? They can use it for hedging, balance sheet, and market making. Yes, they are allowed to use this. RBI also ensure that they are capital norm for any derivative exposure. If you go through the ISDA master agreement, let me show you. In the right side, you can see ISDA master agreement. So basically, before entering into derivative, signing the ISDA agreement is mandatory. Why? Why signing an ISDA agreement is mandatory? Because it allows a uniform framework on jurisdiction, valuation, netting, and credit enhancement. So one agreement cover all kind of deals. No need for separate contract. Only confirmation and exchange. Single global agreement, no separate contract, only confirmation and exchange. It is backed by RBI. It is backed by FBIL. It is backed by FIMDA. Right. So this provide global legal strength, right? If you look at the legal framework of it, just look at the legal framework of it on the right hand side. So friends, in the bottom you can see that RBI introduced a major boost. What RBI introduced? Dual jurisdiction under ISDA. RBI law dual jurisdiction in ISDA, right? Now derivative can operate under both Indian law as well as a common law. That is what RBI has introduced, legal framework for enhancement. So this move empower global bank to